Hello everybody and welcome to the video on types of investments for Financial Literacy 10. Today we'll be talking about different types of investments, and there's a big difference between cash, which is more safe and less risky, and stocks, which is considered to be higher risk. So we'll go through each of these and help give you some information to meet your financial goals. Big thing when it comes to picking investments is that you be able to understand and analyze these four different types of criteria. One is risk. What are the chances that the money I put in will still be there? Will it go down in value or up in value? If I put in $100, can I get my $100 back? That's important that you analyze risk. Risk is also closely tied to return. So something that's lower risk often will come with a lower rate of return. Now that's okay in some cases if that's what you want, because you have to be able to sleep at night and know, if I put all this money into something, can I be comfortable with that? And so you can't just let return, which is how much money you're going to make, drive your investment decision. So return is how much profit am I going to make? Am I going to make 10%, 100% return, double my money? That cannot be the only driving factor, because some people look at returns and go, oh, I want that, and then have to take a lot of higher risk and don't enjoy that risk or that fluctuation. So those two are closely related. And then liquidity is a big factor. So can I get my money out? If I put all this money into a house, can I sell it when a time comes and I want my money back? If I refinish an old car, an antique car, can I sell it and get my money back? If I buy a stock, can I get my money back sometime when I want to sell it? So liquidity is, can I get my cash back? And can I get my cash back without losing money too? And then time is probably one of the biggest factors. Do you have 6 months? Do you have 6 years? Do you have 20 years? That's really important when you make decisions. You can't double your money with high risk in 6 months, right? Those don't go together. So if you want higher risk, you need longer term investment or return. If you want to look at your return, right? How much time you pick, all of these work together to help you pick investments. Okay. The safest type of investment we'll talk about first is these lists here: savings bonds, savings accounts, and the biggest, most popular one is GICs, guaranteed investment certificates. It says the word guaranteed. These are all guaranteed by the financial institution you buy it from. Typically, they're low risk, low return, because the return is closely related to risk. Liquidity is high. You can get your money back from the financial institution you bought it from. And time depends on how long you want to lock it in for or how much time you want to invest. These are some example rates from a local financial institution. Redeemable GIC is guaranteed, and it means you can take it out anytime in the first year. It's only paying you 2.7%, which is better than a savings account, but maybe not enough to grow financial goals if you want to save money for the long term. But you get access to your money and it's guaranteed. Non-redeemable in the other column means I have to lock it in. So I've got a 1 year investment. I have to put it away for 1 year, and the bank will pay me, or the credit union will pay me 4.5%. Some people like this if they're seniors. They don't want to risk. They want to lock away their money. They want to know they have it and get the return. I've seen younger people buy these where they want to just park some money. They maybe got some scholarship money or some down payment money or some wedding money, and they want to park it and just get their 4% and know that they're not going to get any risk to lose their money. So these are options. I'm going to go right to stocks, which is next. Not meaning it's the same, but it's one most people talk about is stock market and stocks. Basically, when you buy a stock, you're buying a little piece of a company, a little share in that company. And if they do well, you do well as well. So people are attracted because there's a possibility of return. People talk about the stock market all the time. There's anywhere from a low rate of risk to a high rate of risk, depending on the company you buy. Your return could be extremely negative, where you lose all your money, to extremely positive, high rates of return. Yes, liquidity, you can sell your money and get your money back, but are you going to get back for what you paid? So it's liquid. You probably get your money back within 2 days with your investment account, but are you going to get what you paid? And then time. Some people are day traders and they trade every day. Some people buy and hold stocks for the long term, like Warren Buffett. They just buy good quality companies for long term. So time could really vary with stocks, okay, which makes it more risky. How you make money is if the company makes money and gets profits. Like, for example, if you buy a bank stock, they make huge profits every quarter. They will pay you what's called a dividend. So you'll get a little bit of stock money and grow your stocks that way. And then gain on stock price. So if I buy a stock for $70 a share, I hope it goes up to 80 or 90 or 100. So basically, the shares are traded kind of like in an auction mart, buying and selling from each other. So we'll explain stock markets in a minute. I just want to show you Lululemon. So Lululemon's a popular company. We see Lululemon started back here in 2007 at $14 per share. Took a long time to make money with, you know, getting their product quality under control. If you paid $14 US for one share at Lululemon, that's for one. It was worth $100 per share in 2018. So it took 11 years to grow to $100 per share. But I think if you bought and held Lululemon, you didn't sell it along the way here, you would have been very happy with how much money you made. If you can see, it started to grow. Lululemon grew their company, grew the products that they offer. It hit $300 almost US in 2022. It, excuse me, hit $500 per share in December of 2023. And you'll see now that August 9th, it closed at $238 a share. You'll also see a little blip here. That was 2020 when the share price fell dramatically with COVID. And so there's lots of volatility. And if you buy one share, you may go up or down depending on what's happening, not necessarily just with Lululemon. It might be what's happening in the world, in the markets, in the health crisis, 9/11. All of these things affected stock prices because people get scared and sell or buy. There's lots of factors that go into the share price. But if you own one of these shares and you paid $500 last December, you've lost half your money. So that's the risk with buying stocks, is we never know what's going to happen. We don't know what's in the future for Lululemon. But if you put all your eggs in that basket, you're really hoping that Lululemon's going to make you money. A better option might be more of a mutual fund, which I'll talk about in a second. Stock markets are where the stocks are traded. Think of it like an auction mart where there's buyers and sellers. Somebody wants to sell, and you hope there's a buyer out there that's going to pay you more than what you paid. In Canada, the stock market's called the TSX. In the States, there's the Dow Jones, the New York Stock Exchange, and the NASDAQ. And I'll just show you the markets, like just so you guys know what we're talking about. Think of the market like a grade in a class. So if you have an 80% in your class and you get assignment done well, your mark will go up, right? And if you have a bad assignment, your average will go down. That's kind of like the stock market. Right now, it's closing at 22,000 in Canada, closing at 5,300 for the S&P, which is the 500 biggest companies in the States. If those companies do well or don't do well, that'll affect the index, which is like the average of all the stocks. So we just hear that number on the news every day. You might want to start paying attention to that number and just seeing what the stock market's doing. I wanted to show you a 5-year graph because if you didn't invest in the markets 5 years ago, you see the S&P 500 in the States, over the last 5 years, it made 84% return. So some people go, oh, I'm going to wait, I'm going to hold off. Well, if the longer you wait, you've got time on your side when you're young. You can make that money over a long period of time. And in any stock market, actually, we've watched the returns since the early 1900s when we started to have the stock market and trading. If you have 5 years or more, it's never lost money. It maybe not made great returns in the 30s and the 80s when we had some heavy recessions, but 5 years or more has always made money. And you see some pretty good returns here over the last 5 years in the markets. TSX is 35%. This is just a measure of what the stocks are doing as an average. Now, if you don't want to buy just individual stocks, you might not want to because there's stock market crashes, right? Times where it goes down. We saw that happen in 2020. The entire stock market crashed right here, and that was a tough time. Now, if you panicked and sold, you want to sell high and buy low. Some people were just selling because everybody was selling. It was a health crisis. We weren't sure. But if you really understood what was happening, it started to climb back up. That was maybe a good time to buy stocks because they were cheaper. Now, buying and selling stocks is really hard. We don't know what's going to happen. We don't have a crystal ball. We saw Russia invade Ukraine along the way here. We saw some downturn in the market here. But you see overall, it's on an upward trend. So it's hard to tell what stocks to pick. A better option might be, investing just in a general fund called a mutual fund. In this way, a mutual fund might invest in all 500 companies in the S&P 500, and you'll see that would have made you 11.8% over the last 40 years. So a better option that I like to tell students about is what's called a mutual fund. So this fund might actually buy all 500 stocks in the S&P 500, and then you don't have to buy one stock and worry about what's happening. It's still, I've got the same risk, low to high, because it depends on which mutual fund you buy. There's thousands of mutual funds out there, but your return could be negative or positive, again, depending on what mutual fund you pick. But you have to know what you want. So if you want high risk, high return, and a long period of time, we can find you those. Liquidity, you get your money out and you can be anywhere from short term to long term in a mutual fund. But you don't want to buy a risky one and have a short period of time because you might not be happy with your returns. One of the mutual funds I like to talk to students about is this first one called Balanced Fund. This is a fund that invests in a whole bunch of different industries. There's about 2,000 stocks, individual companies in this mutual fund. There is across the world. You see Canada, US, Europe, Asia. Emerging markets is probably Brazil, and then some real estate in here. You see the returns were 10%, 1%, like they fluctuate a little bit, right? Down 3.7, up to 12.6, down 10. But overall, the average is 5.8. So 6% return is better than the GIC rates I just showed you. And this one is considered low to medium risk because there's so many stocks in this fund. You're spreading your risk out over a great number of investments. You only need $500 to invest in this. So this is a really good option for people to pick when they're just starting out. You can invest your RESP money in here. If you have RESP money, when you start working, you can invest your TFSA money in here. And this fund will give you a broad diversification, we call it, and spread out your risk and make a decent return. I want to show you this one too, because this one's very popular, especially with tech being where it's at right now, with the tech industry absolutely booming. This fund is called the Global Technology Fund. Okay, it buys the top tech companies in the world. You'll see there's 92 stocks in this company, 92 different investments companies. For you to buy one of these companies, you see Microsoft, Alphabet, which is Google, it would cost you hundreds of dollars for one stock, one share of any of these companies. You see Meta, which is Facebook, Netflix is in here. But the beauty of this mutual fund is you put your $500 in. You see the value of this fund is $1 billion. So there's $1 billion that everybody's put a little bit of their money in, and we all share in the profits that these companies make. You don't have to pick the 92 stocks. You can't afford to buy 92 stocks, but a mutual fund allows you to participate in what those 92 stocks are doing simply by putting your $500 in. So you get a piece of the pie. And it's a nice, much safer way. This is considered medium risk, which is good because it's not high risk, which individually those companies might be. You're spreading out your risk and you can still make some of this return. This mutual fund made over 30 some percent last year in 2023. So it's a nice way to help you meet your financial goals without taking on a lot of risk. The other investments that I mentioned is alternative investments, we'll call them. So these are anywhere from collectibles like antique items, rare items, coins, real estate, even if it's hard to sell land or house in a place that you bought that you might not get your money back, and cryptocurrency. These are all considered alternative. High risk, you could lose all of your money if there's no buyer for what you have. If you buy a house, real estate, or a collectible item and no one wants what you have, you put a lot of money into something no one can buy. And then cryptocurrency is online. It's underground economy. It's a currency that is very high risk. And again, buying and selling something that's not tangible. It's right. It's digital. And so these are considered very high risk investments. Wouldn't put a lot of money into these as well. The one last thing I want to show you is the rate of return of the different investments I show you makes a big difference in what you have long term. So this is a show about how much per month over 25 to 60. And I put a little bit more here, $100 versus $250. And then I kept increasing the rate of return, which is the GIC or mutual funds I showed you, and actually how much you'd end up getting at the end of your 60 years if you're investing from 25 to 60. This is called a financial calculator, and we can demonstrate these. But basically what I'm after here is the 4 to 6 to 8% return. So picking your investments makes a big difference in the amount of money you have long term. I'll be doing another video on calculating financial returns coming up, but I wanted to make sure you guys saw this video, this comparison as well. So it really matters where you invest. In the end, here's another example, just some good advice from the Personal Finance Club. If you invest $500 per year for 30 years into just investment fund, like an SP 500, all of these global stock market crashes happened, but you now have got $1 million in your fund. And so it is easy, well, it's relatively easy advice to give. Live below your means, invest early and often is great advice for students to help build their portfolio and review their financial goals for the long term. Thanks for watching and hope you happy investing.